Henry's been here in New Zealand for about 40 years, but I'm going to really be talking about a global perspective as opposed to the local perspective that we think we bring to the marketplace. I've got about, I don't know, half an hour of content, but really what I'm trying to do is to have a couple slides to show you. Maybe I'll just talk then. Okay. What I want to talk to you about is 5 global trends that we think are really important for you guys to watch over the long term and that we really will have an impact on the New Zealand market. So I'll take you through those 5 global trends with or without slides. And this thing, I got the clicker here, but there we go. All right. And then I'm just going to talk about the implications for New Zealand. So I really hope we get to get to some questions at the end to get your perspective on some of the issues that we're going to talk about. But let me just get into the 5 issues to start. First and foremost, I think the investment environment is the first issue that I would recommend that we watch over time and really should have some dramatic implications for New Zealand and the global insurance market. We've been watching the way that interest rates have moved over the past decade, 15 years. Up on the slide here, we've got the US, New Zealand, and Australia, and the interest rate movement since that time. We've obviously seen a tick up in interest rates in the short term, but why are the interest rates an important variable for New Zealand? Well, 2 things, and I'll come to the second in a minute, but I think the first is really when we have that little coming from the investment account, that little return coming from the investment account, it puts that much more stress on the underwriting account. And when interest rates are a bit higher, then our ability to rely on investment income to offset the underwriting income goes up, obviously. The second, which I'll come back to in a minute, is the low interest rate environment really has attracted the capital markets to the insurance industry. And the low interest rate environment in any asset class, or drives the returns in just about every asset class. And the lack of investment return from any investment class right now has brought the capital markets to the insurance industry. Whether we want them or not, they're here. But that's one of the trends I'll come back to. But I think the investment environment has driven that short-term interest from the capital markets. But maybe to go back to the underwriting, what we've got here is I don't have the stats for New Zealand, so I apologize, but we're showing you the Australian market. Across the top is really the interest rate that you might be able to return on might be able to track on your investment portfolio. The vertical axis is showing premium to surplus ratios, so see how leveraged your writings are. And the interesting piece is to look at how the demands of the underwriting account have changed over time. If you go back to 1990s, you were able to, because of the investment environment at the time, to run a combined ratio around 100, and you were able to meet your 12% return on equity target, or whatever target you choose to have, but to choose 12% for the sake of this exhibit. Obviously, with investment rates dropping over the past decade, that's put pressure on the underwriting. So if you look at the middle red box talking about, in 2002, all of a sudden the combined ratio necessary to maintain that 12% ROE had dropped significantly. And again, if you go to 2012, 13 for the box on the left-hand side, as you guys see it, all of a sudden we're in the upper 80s for a combined ratio. Now, why is that important to New Zealand? Well, I don't think the investment environment is going to change dramatically in the future. And Bill talked about that this morning. The free money that's been going into all these markets around the world isn't likely to drop off dramatically in the near future. And so a spike in investment rates I don't think is going to happen very quickly, which means that the underwriting account is important, which means that the underwriting income from that side of the balance sheet is going to be really important as well. So I don't think that from a reinsurance market perspective, there'll be that much change in the pressures that New Zealand feels. I really think that the reinsurers on a global basis are under pressure to make sure that they're getting their returns from the underwriting side of the account. So we may see some variability in pricing. I don't think that's going to dramatically change from the reinsurer's perspective. Now you say, well, of course you'd say that, but I think this math goes on at every single insurance company in the room as well. Your boardroom is frustrated by this because of the lack of the investment income coming through. So it's not just my opinion. I think if you go to your boardroom and if you guys sit there, you're very much feeling the same sort of pressure. The second issue I want to talk about is tail risk. And I think this has a dramatic implication for New Zealand, and you guys have obviously been through this, but what we're talking about is those types of events that are out in the tails of the distribution that we may know about or we may not know about. And unfortunately, with the way that climate change is going on right now, the frequency of these tail risks seems to be on the increase. I'm not going to get into the politics of climate change, but the idea that we are seeing more extreme weather, we'll leave the question of earthquakes and climate change to another day, but more extreme weather, and certainly the idea that, let me go back one actually, but we are in a situation where many events continue to surprise us. So the first quote up there is from the GNS here locally, obviously after the 2010 earthquake. Rather dramatic statement, we didn't even know this thing could rupture since the gravel was put there. That's an unknown that all of a sudden shows up in the tails of the distribution that we didn't expect to see. The second quote there relates to Japan. We thought an 8.0 was the largest event we could have in that type of fault. Lo and behold, we had a 9.0. The third quote relates to the Italian quake, where they had never seen any seismic activity anywhere near that part of the country. So as time goes by, as weather patterns change, I think we're likely to continue to see a tail exposure that somehow hasn't been priced into the underwriting account. And again, I was trying to find some New Zealand data, but this is an RMS look at the industry exposure at the country level. And unfortunately, they don't have a database set up for New Zealand at the industry exposure level. So I've had to rely on the US data here. But in the United States, we have for many years talked about a loss of 50 billion US dollars and how much of a tail event that would be. Well, we had a $50 billion event. And what's interesting when you look at this slide here, all that we've done is take the entire industry data, put it through the RMS model, and look at the exceedance probabilities that are generated by the model. And you'll see at the 1% exceedance probability, which is a 1 in 100 event, we're talking about, so VAR, which is the average of the tail, if you like. The average loss there is $180 billion, as you can see there. The TVAR, which is the average of those losses once it exceeds the VAR, if that makes sense, so it's the average of the far part out of the tail, is showing $275 billion. Well, people in the United States are talking about a $100 billion event as if it's this dramatically huge event with the lowest probability of outcome. Well, certainly when you go on RMS's tool, a $100 billion event isn't even a 1 in 100 event. It's something less than that. If you go further down those curves, the United States insurance industry only has about $600 billion of capital. And all of a sudden, you're getting into event sets further down the tail there that exhaust the entire capital of the United States market. So my point is that I think as we think about the tail risks and the events that start to happen around the world, and you guys have certainly experienced a fair number yourself, I think the capital demands of the reinsurance industry aren't going to change, because I think these types of events put additional pressure on the capital account to make sure that those events are contemplated in your pricing and in your capital structure. Closely related is model risk. We rely on these models much to our experience, where we see time and time again that these things have very little resemblance to reality. And unfortunately, when we start to rely on models in a large way, we get put in the same category as the banks, which is never a good place to be, because their reliance on the models during the global financial crisis led to their undoing, especially in the United States. We almost saw the system go down, literally go down, because of the reliance on the financial models. But the piece I want to talk to you about on the models, obviously we talk about tail risk and how well the models can accurately describe the tail risks involved in the industry that we're in. But the amazing thing is how you can twist the knobs and dials on these models to get to just about any answer that you want. And all we've done, on the next slide, I'll show you 3 assumptions. And again, I didn't have the Australian or New Zealand data to make the math work, so we ended up using a European windstorm model just to change it up a little bit. But you'll see just on the way you turn the dials at the model level, and we're talking about loss amplification, which is demand surge, so the scarcity of product after an event and the prices that happen. So that's what loss amplification is. Storm surge is obviously wind-driven water, so this is very much a hurricane or a windstorm type event. But if you look at the base case excluding those things, you build an average case and then you build a worst case example, the difference in outcomes is pretty dramatic. And you can see that the description of this is actually one of our customers in Europe. When you look at the way that their view of their own balance sheet exposure from European windstorm changes, just by the way you set the dials, it's a pretty dramatic impact. In some cases, I think people are buying to, and I know you guys are talking about moving from 1 in 200 to 1 in 500 to 1 in 1,000 potentially, or yes, it's hard to tell if that's a definite thing or not, but 1 in 1,000. But 1 in 1,000 based on what? Based on who put the dials where and what things are in the equation, what things are out. So I think for model risk, again, why is that important in New Zealand? Because I think as you guys move, or as the regulator talks about moving further out in the tail and making sure that you're buying and being protected to a tail event of 1 in 1,000, what does that mean? Because all of a sudden you can see here it means very different things, where 1 in 1,000 is in a very conservative position and in a very aggressive position. And there are additional knobs that you can turn in RMS, as you guys well know, that aren't even in this calculation. Secondary uncertainty. How do you choose to treat secondary uncertainty? That's not even in here. And that just makes the discrepancy, the disparity, that much larger. So I think part of the conversation you're going to have to watch as a part of the trends from a global basis is really how do these models get revised? And how are the dials being set? And what does that mean for the capital base that's required for New Zealand insurance exposures? This is a conversation that the modeling companies are running away from right now. So RMS and others were used to be in the position where they would tell you and they wanted to be helping you with a point estimate of what your exposures are. This is your number for New Zealand earthquake. Well, they've gotten smart now because they were so far off in every single event that they're now saying that is your job. We'll give you the tool, we'll give you all the dials, and you get to play. But I think that makes our life that much more difficult, especially as we try to communicate with regulators, rating agencies, customers, about really what we're trying to do from a model risk perspective. So I think this is the third one that I would encourage you to watch as we think about the global trends. Coming back to capital markets, as I said before, the low interest rate environment has driven the banks, the hedge funds to our doorstep. Whether you want them here or not, as I said, they are here to stay. Just some data to help people get a perspective on it. There was about $45 billion of risk transferred in 2013. The projection is that number is going to go up. Actually, it's 2013 year to date, I should say, by the way. The projections are that that number is just going to keep expanding. Right now, this is only in the nat cat space, so the natural catastrophe space. An interesting question is does it leak over to the larger property casualty business in some way? Does it leak to the life business in some way? These are open questions, but what we have is a surge in capital coming to our marketplace, which should be a good thing, by the way. Should be a good thing. But where's it coming from? And this slide is different than in the book because I ended up the colors were a little bit wacky. So you'll see that the pie slices are a little bit different in size. But the message really is from 2007 to 2012, look at the change in the red slice and the darker green. The amount of new money that's been attracted from the pension funds and the asset managers. And this pace of attracting capital has not slowed down, again, primarily because there are a lack of really impressive investment options somewhere else. So all of a sudden, cat risk looks pretty impressive because you can get 6 points above LIBOR or whatever it may be. You can get some additional margin where you can't get it from equities or the bond market or whatever else there. So again, the trend to watch here, I would posit, is how sticky is this capacity? If interest rates go up, how much of this capital goes back out of the marketplace? I don't know. Post-event, if something were bad to happen, does this capital really know what they've gotten into? I don't know. If you have a tail on recoveries like we have in New Zealand, which unfortunately, and I'll talk about in a minute, is not the typical tail that we expect on cat business of 2 or 3 years. We're talking about, like, I hate to guess what the event in 2010 when the industry will actually pay the final exposure. But I can tell you these people are not set up for that type of timeline in terms of getting their capital out and getting the appropriate return. They're expecting 2 or 3 years of recoverables. I get my money out of the fund, I can go put it somewhere else. When they have exposures that are going 6, 7, 8, 10 years, let's hope it doesn't take the industry that long, but if it were that long, I don't know how sticky this money is. And then all of a sudden, where do you go for your recoverable? Who do you call? If the fund has changed and the money has come out. So there are a lot of open questions here. I just think this is, again, from a fourth trend that you need to watch from a New Zealand perspective, I think this is a really interesting one. It should technically, if the capital is sticky, drive down the cost of reinsurance. It should. We've seen that happening right now in Florida, which is where this capital started to come in first and foremost. A great trend to watch, which ultimately could benefit the consumer with a cheaper product if the insurers were to pass on the costs. This capital will impact the 1 January renewal in Europe. I have heard that some of the larger Australian insurers are talking about the concepts. So it's at your doorstep. Nothing has been done really in this space, but it's at your doorstep. And I think that's really an interesting question to watch as an industry, and that will have a very, well, especially with the capital base of Australian impact in this market, we'll have to see what the impact is longer term for the New Zealand market. The last one I would ask you to watch from a global reinsurance perspective is the regulatory environment. And we've talked a lot about regulatory this morning, and you guys, I'm sure, said I didn't show up here to talk about regulation all day. But I think the interesting dynamic from a reinsurance perspective is every jurisdiction that we operate in around the world is trying to find some way that they can ring fence the capital behind the insurance exposures that we assume. They want to have that capital onshore in a way that they can get to it, they can control it, and in some ways cover their backside if the bad thing happens. So from a regulatory perspective, the frictional costs for companies like mine, the large multinational companies who are trying to operate in jurisdictions, even you guys, if you were operating in a single country like New Zealand, the costs involved in making the regulatory piece work are going up dramatically. Our company is flat from a headcount except for one department, and that's the audit department. You can hire as many auditors as you want because they are necessary to make the regulatory environment work. So the fifth trend I really think you need to watch is how the regulatory environment impacts the frictional costs that we all have to carry to run our business. And it only means one thing the way the markets are going right now. It means the costs are going up, which means the capital base has to expand, which means prices aren't going down at least. So I know that you guys went from basically zero regulation before the quakes to a significant amount of regulation now, so you're enjoying the same pleasures that we are. So, and the worst thing about this is that every jurisdiction has a different view of how to do it. Some people want to have rules, some people want to have principles. Some people want to have a global view, some people want to have local view. You can go on, but we are not optimistic that we'll get to a global framework that's going to work for large companies. And it's just too complicated, and the local jurisdictions want their own capital base to control it, so we are not optimistic that any global scheme will come together to make the frictional costs go down on this. So I think this is, again, if you're thinking about what's impacting the reinsurance market and what the reinsurance market brings to New Zealand, can't ignore this one because it's moving quickly, unfortunately. We wish it was more simplification, but it's not. Every single jurisdiction wants to have their own rules and apply them to every single market that does business in their country. So those are the 5 trends I want to talk about. What does that specifically mean for New Zealand? Well, a couple things. As I sit from the outside and look at your marketplace and try to understand how it works, I think the Quakes have been a really good example of, there are only 3 places where the consumer or the industry or the government is going to get their money from. And when you look at the total exposure, it's either going to come from the consumer, it's going to come from the government, or it's going to come from us. And as we try to balance those 3 pieces and try to make that equation work going forward post the earthquakes here in New Zealand, I think there's still a lot of open questions in terms of what that's really going to look like. So I think when you think about those 5 global trends, and then you put that alongside what the consumer is able to afford, in increased deductibles, or I know you're not talking about supplements, but if supplements were to come in, the exposures that the individual would have to assume. You heard the minister this morning talking about de-risking his balance sheet, so he doesn't want any more of this. So it really comes down to the insurance industry. So I think one good thing that this country has done over time, and we talked about it this morning, is the insurance penetration is second to none, really. And I think that is a great attribute of this marketplace, in that the consumer and the commercial market is well protected from these large peril sets. And I think you guys should be proud of that, and as an industry, that's something that a lot of other places are struggling with. And especially as you see something nasty like's happening in the Philippines right now, and you look at the insurance penetration in that country, and the lack of help that those people are going to get from groups like this, and how much it falls back to the individual, the consumer, and the government, it's kind of an unbelievable chore. But you guys, on the back of the earthquake, it was well set up already, and I'll come back to the places that weren't well set up, but it was well set up so that a vast majority of the exposure was taken care of with private insurance. I think that is a key trait of the marketplace, that when we look at the insurance industry, that bucket of the insurance industry's contribution to the exposures, I think that's pretty well done. But obviously, when you look at the size of the insurance market here in New Zealand relative to the exposures that you guys have given, with the earthquake peril, for example, it's a game that you can't win. Nobody's going to get paid back here. It's just not possible. So you start to rely on the reinsurance market for that much more of the solution, because the capital base, there's just not enough premium flowing through the economy to make it work, to make the math work. So you end up relying on third-party sources. And try again. The last piece I just thought I would share to give you that additional perspective on the reinsurance. These are our own numbers. So these are Gen Re's numbers in various events around the world, and where we are at paying out the liabilities that we have incurred in those marketplaces. Again, this is a place where there's a mistake in your slides, because we had some product mix numbers, but the 26% is different than I think it shows 3% in the book. 26% is the accurate number, but it's a pretty amazing statement about these are liabilities that we have on our balance sheet that we owe somebody in this marketplace. These are not items that are under dispute. These are not items that we're refusing to pay, but we have only paid a quarter of our liabilities. And that speaks to the complexity of the situation. Unnecessary complexity? I don't know, we can talk about that later, but the complexity of the situation with land issues, with the EQC, with multiple events, we don't see this complexity anywhere else in the world right now. So as we try to pay what we owe you as an industry in good faith, the tail on our own exposures will be many, many years. And there are some events up here, Chile, for example, where we paid every single dime we owed, every single dollar that we owed, in just over 2 years. Yet we're going to be many, many years before we pay our full exposure here. So what does that mean? So I think that as we think about those 5 issues and the complexity of the world and where the world's going and the way that the environment here is in New Zealand, I would posit to say that the reinsurance industry is changing. I don't see many things on this list that would reduce the amount of capital that reinsurers are going to have to carry in the future. The only thing up on that list I would say is going to change the market here potentially is the capital markets. And how quickly that gets here and what kind of impact that has and how long it stays is an open question. So from a reinsurance perspective, I think the pressure, if you want to put it that way, from the external marketplace to New Zealand, I don't see it decreasing in any way. Again, the capital markets may offer some relief, but the other 4 issues up there make for a situation where I think that the pressure from the reinsurers is going to be maintained, and I don't see that changing dramatically if I think about all 5 of these trends in the longer term. What I will say, though, is we are optimistic based on what we've seen the marketplace doing since the Quake events. Things like deductibles, things like indemnity value, things like upgrade costs, and those things getting forced out of the court system and the statute actually being upheld. So I think from the reinsurance industry's perspective, if I can talk on behalf of the industry, I think it's been, post-earthquake, it's been a very level playing field. And I can't say that about a lot of markets. So at least from our perspective, from the Gen Re perspective, we're going to be committed to this marketplace because we found that the level playing field has been maintained. In many markets, we see that when something bad happens, they go for the deep pockets and look for somebody to pay for something that may be outside the contract. It may be something that was not foreseen, and all of a sudden the insurance industry is the person with the deep pockets, and they start compromising the value of contracts. If we start to see that type of behavior, again, we haven't seen it here, and we have seen a little bit of poking and prodding a little bit, but I think as a general statement, I think as long as the contracts that we have with you, as long as the government is fair with the insurance industry, as long as we try to continue to unwind the complexity that we've got with the EQC and that whole situation, I think, at least from our capital base, we're very committed to being here. We want to be here. We think we have a lot to offer. But more than anything, I think you guys should be very proud about the way the government, the industry, and the council has worked together to make this a very fair playing field. And it's something that will attract additional capital in the future, as opposed to chase capital off based on the way it's worked to date. Those are my comments. Thank you.
We have plenty of time for questions, so if anyone's got anything they'd like to raise. Jackie, we've got one down here.
Mo, and thank you on behalf of the industry for coming to
you.
this part of the world, not just for the conference, but the engagement you've had with us. One question as you were speaking that became apparent, we heard from Jeff earlier about contagion and systemic risk. Seems to me as pension funds are investing more and more into stock of insurers and underwriters right around the world, then they start to form the basis of the cat bonds. It seems to me that that could increase some systemic risk as you get that contagion risk flowing, and I'm just interested in your views.
Well, there's a really fundamental question about whether pension funds should be investing in assets that can vanish, whether they are doing their best, I'm not sure the right word, but they have a fiduciary responsibility to the pension holders. And so this is a personal, this is not a Gen Re position, but I struggle with the fiduciary responsibility when you invest in an asset class that all of a sudden that capital base is gone altogether. I know that hypothetically exists when you're in the equity market or the bond market, but that potential is so far out in the tail of possibilities that I think people kind of write it off. The stock market going to, or a stock going to zero is doesn't happen that often, but a cat bond that goes to zero, I think it's a pretty likely outcome. So the fiduciary responsibility, I just kind of shake my head at that one a little bit. I think this is potentially another bubble as well, that as we're watching it. We have seen capital chase returns in many situations, global financial crisis being the crisis being the most obvious, but we've actually seen so many people come into the capital market space right now that I don't even know if the consumer will ultimately be well represented at the end either. Because there is this tidal wave of stuff coming in, and even those people who are managing that capital don't even know where to put it right now. So I think it's a trendy thing as well. Everybody wants to have a foot in the capital markets right now. So I share your concern.
Questions? Down the back here.
I'm Michael Drayton. I work for RMS. I developed some of the models that you've shown on your slides.
Yeah?
So first of all, I have no problem whatsoever with your criticism of models. In fact, some people in the audience heard me speak a few weeks back in Wellington, and I said more or less the same things on the points to look out for. So no problems with that at all. What I want to comment on is you mentioned that modelers are running away from giving a number. And I just want to say that I think that reflects a change in the expectations of the market and what the market wants from models. Some years back, people wanted a number. People would say, "Don't give me a range. Ranges are for cattle. Give me a number." Now, if a model gives a number, the first thing that this market knows now is that number is wrong.
Right.
And they want to know what is the range. So rather than running away from the issue, what I think modelling companies are doing is embracing the uncertainty that exists and being open and honest about it, and looking at addressing the regulatory issues more from a collaborative point of view. This is what the model does, this is what it doesn't do, this is the range that you get if you adjust the settings. And so while I don't disagree with you, I would just maybe spin that issue a different way.
I think that's a fair statement, and I think the industry was pushing for a number, so I can talk to my analysts, so I can talk to the rating agency, so I can talk to the regulator. And I think the criticism of you guys is maybe a little bit unfair, because that's exactly what we were asking you for. Now, whether or not you should have been selling us that witch brew, I don't know, but we were asking for it. But
Rebecca, we just grab that mic.
Thank you. Hi, Mo. I just wanted to ask you about your 26%. Does that include Gen Re's exposure to retrocession contracts, which are much higher up, or is it only direct exposure
yeah,
to
we don't do any
insurance?
retrocessional business.
Right. Okay, so that's just direct.
And we also don't buy any retrocession ourselves, so that number is really, that is our true exposure to this marketplace.
Thank you.
Treaty and facultative.
Thank you.
Hi.
Hello, Winley here. I was very fascinated by your slide on the reinsurance percentage paid in the different countries. How much, 100% Chilean, 91% Japan, only 26% in Christchurch. How much of that is attributable to government red tape, the interlink with EQC, policyholder attitudes, insurance industry, or sort of the types of damages in the different countries, and sort of who needs to move their feet quicker?
Yeah, I would probably say all those things, quite honestly. But I will say I'm pretty underinformed, so I'm not sure I'm going to wade into that. But the only thing I will say is, from the outside, as a very uninformed or underinformed observer, the complexity of the situation seems to resemble a Rube Goldberg picture. I don't know if you guys remember. Rube Goldberg is a guy who designed vast contraptions to accomplish simple tasks. And I just can't help but thinking that if you had a clean sheet of paper in this country, and I know you don't, but I think you would devise something very different. And so the complexity is what it is. It started with the EQC in the 1930s, and it's evolved to where it is today, and we have all our own issues that we learned on the back of the earthquake. But I think the challenge for this industry is going to be really, how do you get far enough away from that which has evolved to today to actually make a meaningful impact on that complexity? Because I think the consumer loses. They really lose. I can see why there are people yelling at Jackie to say, pay my claims, because they can't understand the complexity. I don't know how to fix it, but I think it's all those things that you mentioned, and I hope it's a rather unique occurrence that we have that many issues in terms of number of occurrences, that we have the land issues that hopefully will be resolved by next time, that we have any of these number of issues. I hope that we have reduced the complexity in some way, but I don't think this is a place where evolution will get us to a better answer. I think you need revolution on this topic, but I'm probably stepping on landmines. I don't even know what I'm talking about, but just from the outside, it looks far more complex than it needs to be. But
Can I just make an observation that we, like you, want to pay our claims, and we have clients who simply won't make their minds up. There's no way you can force someone to take a check, so we're as frustrated as you are.
That's one of the claims managers from the industry.
well, and I think it's just it's a very sad statement for all of us, because we have pride issues in our industry in general. We aren't proud of our industry. And then when you get into an event like this and we start getting dragged through the muck a bit more, and this is the same around the world, by the way, it just makes it that much more difficult to prove to our policyholders that we are on their side. So I hear you, and I appreciate your context. I don't know how this one gets solved, unfortunately. Yeah, I understand. understand.
No, we had a 6.6 earthquake in Wellington. That's just sort of a general thing we have down there. And it was actually quite invigorating. When you're sitting there and the whole thing, the pillars in your floor are shaking, and John Lucas came rushing out of his office and running around the room going, "Oh no, that's the end of reinsurance as we know it." And then I was following, screaming around behind, saying, "Oh no, more EQC claims!" Oh. And you know, it raises the question of, you know, New Zealand's a risky environment, and I know that you've said that Gen Re is committed to the market, but you know, when is enough for reinsurers? Is it, you know, did we nearly reach that point at, you know,
I wish you guys a lot of good luck over the next decade. Let me put it that way.
All right, no more questions. That's the end of it.
Because I do feel if you have a run of bad luck in a place like Wellington, in a place like Auckland, I don't know. I mean, I can't predict the future, but we know we're never going to make our money back here. But we also know that math has to work for us globally, and at some point, if there's such an exposure and severity here that we can't make it match globally, I don't know. I hate to think about the outcome, quite honestly. You don't take those decisions lightly. We've been here since the 1970s, and to think that we're going to pick up sticks and go home, it's hard to think about. But I really hope you guys have some good luck. But if the bad things were to happen, I don't know. And you have seen insurers and reinsurers already pack up and go home. Now, were those naive capacity in the first place who probably didn't realize what they had their hands on? Probably. So I'm hoping that if we have informed partners that you're taking risks that you get paid for, I think that's a balance that we're all trying to find the right point on. But
yeah, remind me to send you a copy of the GNS study that says that the earthquake in 1856 de-stressed the Wellington Fault. You know, we're hanging our hat on that, and you know, hopefully that'll work for us. Any more questions? The question over here. Thanks.
I had a question about insurance penetration in New Zealand. As you said, you know, it's one of the great advantages, you know, that we've had up our sleeves for the last 3 years. In terms of who pays to retain that, as you said, there's the consumer, there's the government, and then there's the industry. The consumer can, you know, pay a bit more, can change their deductible, can limit their cover. You know, those are really movements around the edges. The government can contribute, and already does, as you know, through the EQC. And I'm interested in the third pot, the industry, what your view is on how the industry can ensure the retention of penetration in New Zealand.
well, I think a lot of it comes down to that level playing field I was talking about, because I think that whether it's the external insurance capital providers or the external reinsurance capital providers, I think that people are looking for a place where they understand the exposures on the date that they sign the contract and they get paid for that. And I think if that level playing field from a political perspective changes, the political risk, I didn't pick it up, and I had a couple minutes with the minister after his session to try and pick his brain to really understand what the political risk might be. I think if that political risk heightens in some way, that the insurance industry is seen as the patsy at the table, or that they have deep pockets that we might tap into, I would really be concerned about that third bucket in terms of our willingness to stay here. And I'm not just talking about reinsurance, I'm talking about insurers and reinsurers. I think that trade is a fair one today. I'm a little distressed to hear in the market that prices are starting to drop off a little bit, because I think we just got to a place where I think we're being adequately compensated for the risks that we're taking. I think if prices drop off significantly, I think that's something else we'll have to think about in terms of how well we get paid for the risks that we assume here. But I do compliment, and I complimented the minister this morning, I do think that the government has done a good job walking the line between listening to consumers and pushing the industry without going too far. In many jurisdictions, we see the bashing of the industry starts first, and it stays there and doesn't move. But I think that I wish we had some more rational politicians. In Washington, we don't seem to have many of those, but you guys seem to have a couple. So